Have you ever just looked at a huge, successful company and wondered why they struggle so much to change? Meanwhile, some tiny startup can just flip its entire business model overnight. Well, it's not just about size. The real answer is a psychological trap, and it's set by their own success. Let's get into it.
So this is really the heart of the matter. Why can't these giants dance like startups? You see a massive company, it sees a threat coming, but it just seems paralyzed. And at the exact same time, you've got a tiny startup that can completely reinvent itself over a weekend. It's not just bureaucracy or red tape. There is something much deeper, almost mathematical going on here.
All right, let's meet the two main characters in our story. On one side, you've got Goliath Corp. It's huge, it's stable, it's predictable, its entire strength is its consistency. And on the other side, Startup Inc. Small, agile, experimental. Its strength is its ability to change on a dime. The real difference we're going to explore is why Goliath is so slow to pivot, while Startup Inc. is literally built for it.
Okay, so to really understand the giant's trap, we first have to talk about one of its most important tools for talking to the world, the dividend. And it turns out it's about a whole lot more than just sending cash to investors.
You've got to think of a dividend from a big, mature company as less of a transaction and more of a public statement. It's a powerful broadcast, right? It's a message sent to every single investor, analyst, and competitor out there about the health and the confidence of the company. It's a signal.
And this is actually grounded in something called signaling theory. The basic idea is, well, actions speak louder than words. A CEO can write "the future is bright" in an annual report, sure. But the act of committing to a massive, regular cash payout sends a much more credible message. That the managers, the people with all the inside info, are truly confident.
And what exactly is that signal saying? Well, a steady dividend tells the market that you have reliable earnings. It shows you're so confident about what's coming next that you can afford to part with cash. It signals disciplined management that isn't just wasting money, and it basically declares, hey, we're a mature, healthy giant. It is a promise of stability.
But that promise of stability, that's exactly what creates the trap. Because when that promise gets broken, we leave the nice, clean world of rational finance, and we enter the messy, emotional world of human psychology.
And this is the million-dollar question. What happens when Goliath Corp, after years, maybe even decades of steady payouts, suddenly has to cut its dividend? Maybe to invest in some new technology or to fight off a new competitor. The market's reaction isn't just disappointment, it's something way more powerful.
The answer is all wrapped up in a concept called loss aversion. This is a cornerstone of behavioral economics, and it's this simple but really profound idea that we feel the pain of a loss about twice as strongly as we feel the pleasure of an equal gain. So, losing 20 bucks feels way worse than finding 20 bucks feels good.
And this is where it all clicks. That steady dividend year after year, it creates a reference point in an investor's mind. And as the research shows, even a tiny 1-cent drop below that point triggers that powerful sense of loss. A small increase feels kind of nice, but the pain of that tiny cut is way more intense. And this chart just brilliantly shows the math of the trap. The market's reaction is what we call asymmetric. A dividend increase gets you a small thumbs up, but a dividend cut of the exact same size, you get a massive thumbs down, roughly twice as severe. This means it is literally mathematically harder to change course. The punishment for breaking the pattern is just so much worse than the reward for improving it.
And look, this isn't just some clever theory. The data is crystal clear. Market analysis confirms it. Dividend cuts get a much bigger negative reaction than the positive reaction from a similar increase. This kink in the data, right there at that established reference point, that is the very heart of the giant's trap.
And the people running these companies, they are painfully aware of this. In one survey of executives, a staggering 93.8% said they actively try to avoid reducing dividends. They know their investors are wired for loss aversion, and they will do almost anything to avoid triggering that pain and the massive stock price drop that's going to come with it.
So what about Startup Inc.? Why isn't it caught in the exact same trap? Well, because it has the ultimate advantage, a completely blank slate.
It's really that simple. A startup has never paid a dividend. It has never set that psychological reference point in the minds of its investors. So there's no historical promise of stability to break, which means there's no pain of loss to trigger.
This gives the startup an incredible amount of freedom. Investors aren't looking for a steady check. They are looking for explosive growth. They expect the company to reinvest every single penny back into the business to get bigger, faster.
And that means the startup can pivot, it can experiment, it can change its entire strategy without facing that psychological and financial penalty that Goliath Corp would for the very same move.
So let's just put it all together here. For Goliath Corp, the expectation is stability, and that's signaled by a consistent dividend. The cost of changing direction is enormous because it breaks that promise. It's like it's fighting against this immense psychological gravity. For Startups Inc., the expectation is growth. The signal is all about future potential. The cost of changing is super low because, well, change is what investors signed up for. There's almost no gravity holding it in place.
Now, why does any of this matter to those of us who aren't running a Fortune 500 company? Because this whole dynamic, this trap, it's not just about corporate finance. It's really about the psychology of inertia.
The dividend is just a corporate version of a universal principle. I mean, we all set expectations for ourselves and for other people. And once those expectations are set, they create this powerful force that resists change, sometimes even trapping us in a situation that isn't working for us anymore.
Think about it for a second. Any success, a promotion, a certain salary, even just a reputation, it creates a reference point. And because of that loss aversion we talked about, any move away from that point, even if it's for something better in the long run, can feel like a failure. This creates a powerful inertia that makes it so hard for successful companies and successful people to adapt.
So, the giant company is trapped by the memory of its past promises. It's a powerful, powerful force. Which leaves all of us with a final thought, right? What reference points from your own past might be keeping you from making a necessary change today?